Welcome to another insightful session where we dive into the world of investments. Today we're setting sail on an exciting journey through the vast ocean of international exchange-traded funds, or ETFs. These financial instruments are more than just a hot topic, they're a powerful tool for diversifying your investment portfolio, particularly in this era of tariffs. We'll be turning the spotlight on three exceptional international ETFs: Vanguard FTSE Developed Markets ETF, VEA, Vanguard FTSE Emerging Markets ETF, VWO, and Vanguard Total International Stock ETF, VXUS. Each of these funds offers unique opportunities and advantages that we'll delve into, helping you understand their potential role in your investment strategy. So, whether you're a seasoned investor or just starting out on your financial journey, these ETFs are worth your attention. Stay tuned as we unpack the details of these top three international ETFs. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. Before we delve into the specifics of the ETFs, it's crucial to understand what ETFs are. ETFs, or exchange-traded funds, are investment funds and exchange-traded products. They're a bit like a hybrid between mutual funds and individual stocks. So why should you, as an investor, consider ETFs? Well, there are several reasons. First, ETFs offer a way to gain exposure to a diverse range of assets without having to buy each one individually. This means you can spread your investment across a broad market, sector, or region, reducing the risk associated with putting all your eggs in one basket. Second, ETFs are traded on stock exchanges, so they can be bought and sold throughout the trading day at market prices. This gives you flexibility and control over when you buy or sell, unlike mutual funds, which are only traded once a day after the market closes. Third, ETFs are generally more tax efficient than mutual funds due to the way they're structured. This means you could potentially keep more of your investment returns in your pocket, but like all investments, ETFs come with their own set of drawbacks. While they do offer diversification, they can't completely eliminate risk. The value of an ETF can go up and down with the underlying assets it tracks. Also, while they're generally more tax efficient, this isn't always the case. Some ETFs can generate unexpected tax bills. And finally, while the flexibility to trade throughout the day can be a benefit, it can also lead to impulse buying or selling, which can harm long-term investment goals. So, ETFs can be a great tool for diversification, flexibility, and tax efficiency. But as with all investments, it's important to understand what you're investing in and to consider your own risk tolerance and investment goals. With that understanding of ETFs, we can now delve into our top three international ETFs. First on our list is the Vanguard FTSE Developed Markets ETF, also known as VEA. To start with, let's delve into why VEA is an enticing prospect for investors. This ETF is a popular choice for those seeking exposure to developed markets outside of the United States, boasting a solid track record and a broad, diversified portfolio. With more than 3,000 individual holdings, it captures a wide swath of companies from Europe, the Pacific, and Canada, effectively mirroring the performance of these markets. VEA's low expense ratio is another feather in its cap. At a mere 7 basis points, or 0.07%, it's one of the cheapest international ETFs available today. This means more of your investment money stays in your pocket and less is eaten up by management fees, a win-win for investors. When it comes to performance, VEA has proven its mettle time and again. Despite the inherent volatility of international markets, this ETF has consistently delivered robust returns. Over the past decade, it's grown an impressive 60%. Showcasing its ability to weather economic downturns and capitalize on upswings. But as with all investments, VEA isn't without its drawbacks. The primary risk is its reliance on developed markets, which can be more volatile than domestic ones. Fluctuations in foreign currencies can also impact returns, as can geopolitical events. And while its large number of holdings provides diversification, it also means that positive performance by individual companies may not significantly affect the overall return. VEA's risk level is considered medium. While it offers the potential for high returns, it also comes with a degree of risk. It's important to remember that past performance is not indicative of future results, and you should always do your due diligence before investing. Furthermore, there's the issue of the fund being market cap weighted, which means larger companies have a bigger influence on its performance. This could potentially skew returns and might not accurately represent the breadth of the market. Despite these potential pitfalls, the Vanguard FTSE Developed Markets ETF remains a compelling option for those seeking international exposure. Its broad diversification, low management fee, and consistent performance make it a strong contender in the world of ETFs. So, if you're an investor looking for a cost-effective way to gain exposure to a variety of developed markets outside the US, VEA could be a solid addition to your portfolio. Just remember, investing always comes with risks, and it's vital to understand these before making any decisions. That's VEA for you, a strong choice for those seeking exposure to developed international markets. Next on our list is the Vanguard FTSE Emerging Markets ETF, or VWO. In the world of ETFs, we find ourselves swimming in a sea of acronyms. But don't fret, each one represents a unique opportunity for investment, and VWO is no exception. This ETF is designed to track the performance of the FTSE, a broad index that includes stocks from emerging markets around the world. So, what makes VWO stand out? Well, for starters, it offers a broad exposure to emerging markets. This means it includes companies from countries that are considered rapid growth and industrialization. Think of nations like China, India, Brazil, and South Africa. These are economies that are expected to grow at an accelerated pace compared to VWO's broad exposure can be both a pro and a con. On the upside, it provides a great opportunity to diversify your portfolio. By investing in VWO, you're getting a slice of many different markets. This can potentially increase your chances of higher returns. On the flip side, emerging markets can be volatile. They are subject to political instability, economic fluctuations, and sometimes less regulation. Higher risk investment compared to ETFs that focus on developed markets. But remember, with higher risk can come higher reward. Now let's talk about performance. Over the past decade, VWO has demonstrated outpacing many of its peers. However, it's important to note that past performance is not indicative of future results. When investing in any ETF, it's crucial to consider your own risk tolerance. As for the management fee, VWO boasts a low expense ratio, making it a cost-effective option for investors. This is thanks to Vanguard's commitment to keeping costs low for its investors. The lower the expense ratio towards your investment rather than fees. In terms of risk level, as we've touched on earlier, VWO carries a higher level of risk due to its focus on emerging markets. However, this risk level diversification and by having a long-term investment horizon. So, who is VWO best suited for? It's a great pick for investors who are looking for exposure to emerging markets and are comfortable with taking on. It's also a good choice for those who are in it for the long haul, as these markets can be quite volatile in the short term. In conclusion, the Vanguard FTSE Emerging Markets ETF. It carries a higher risk level, but also offers the potential for higher returns. It's a cost-effective way to gain exposure to emerging markets and can be a valuable addition to a well-diversified portfolio. It can be an exciting choice for those willing to take on a bit more risk for potential higher returns. Last but certainly not least, we have the Vanguard Total International Stock ETF, or VXUS. Let's delve into the intricacies of VXUS. It's an exchange-traded fund that aims to mirror the performance of the FTSE Global All-Cap ex-US Index, which is essentially a benchmark of stocks from developed and emerging markets outside the United States. By investing in VXUS, you're effectively gaining exposure to a wide variety of international equities. One of the main advantages of investing in VXUS is its extensive diversification. The fund holds over 6,000 stocks from more than 40 countries, spanning across Europe, Asia, Australia, and emerging markets. This broad-based exposure can help mitigate the risk associated with investing in a single market or sector. Additionally, VXUS offers a relatively low expense ratio. With a management fee of just 11 basis points, it's one of the most cost-effective ways to invest in international stocks. This low fee can translate into more of your money working for you in the market. Now let's look at the other side of the coin, the risks and potential downsides. Like any investment, VXUS carries some degree of risk. The fund's performance is subject to the fluctuations of the global markets, and geopolitical events can significantly impact its returns. Also, because VXUS invests in foreign securities, it's exposed to currency risk, Changes in exchange rates can affect the fund's value, either positively or negatively. The performance of VXUS has been generally solid over the years, although it's important to remember that past performance doesn't guarantee future results. The fund has provided investors with a healthy mix of capital growth and income, thanks to its diversified portfolio and focus on high-quality, large-cap stocks. However, it's worth noting that the performance of international stocks can be quite volatile. There may be periods of underperformance or even losses, but remember, investing is a long-term game. It's all about riding out the storms and sticking to your investment plan. Another point to consider is that the fund's returns may not always match the performance of the benchmark index. This tracking error can be due to a variety of factors, including the fund's expenses and differences in the timing of transactions. Despite these potential drawbacks, VXUS remains a popular choice among investors seeking exposure to international markets. It offers a simple, cost-effective way to diversify your portfolio beyond U.S. borders. In conclusion, VXUS offers a balance of opportunities and risks. It provides broad exposure to international markets, a low expense ratio, and the potential for solid returns. However, it also carries the inherent risks associated with investing in foreign securities and the volatility of global markets. With VXUS, you get broad exposure to both developed and emerging markets outside the U.S., a great choice for diversification. We've taken a deep dive into the world of these top 3 international ETFs. We've explored the ins and outs, the nitty-gritty details, and the vast potential that Vanguard FTSE Developed Markets ETF, Vanguard FTSE Emerging Markets ETF, and Vanguard Total International Stock ETF offer to savvy investors like you. We've seen how the Vanguard FTSE Developed Markets ETF, or VEA, provides a broad exposure to companies in Canada, Europe, and the Pacific, a critical aspect for those looking to diversify their portfolio beyond U.S. borders. Its low expense ratio and comprehensive reach have made it a sterling choice for investors seeking a piece of the developed markets pie. Next on our list, the Vanguard FTSE Emerging Markets ETF, or VWO, offers an intriguing proposition. It's your ticket to tapping into the high-growth potential of emerging markets, from China to India, Brazil to South Africa. The VWO is an excellent way to hedge your bets and embrace the opportunities that the developing world presents. Last but certainly not least, the Vanguard Total International Stock ETF, or VXUS, offers an all-in-one solution. With a single purchase, you're getting exposure to a broad array of international stocks, from developed to emerging markets. It's a one-stop shop for global diversification. Now you may ask, why these ETFs, and why now during a time of tariffs? Well, the answer is simple: diversification. These ETFs allow you to spread your investments across different geographies and economies. This can help mitigate the impact of any one region's economic downturn or political unrest, including the ongoing tariff disputes. In conclusion, these top 3 international ETFs, VEA, VWO, and VXUS, offer a unique combination of diversification, low costs, and potential for high returns. They are an excellent tool in your investment arsenal, especially during these turbulent times. Don't forget to subscribe, like, and share this video with your fellow investors. Stay tuned for more insightful investment discussions. Thank you for watching.